Is the stock market about to crash in 2026? The Warren Buffett Indicator just hit a shocking 220.1%, and major financial institutions are sounding the alarm. If you have money in the stock market, you need to hear this. Hey everyone, welcome back to the channel. I'm your host, and today we're diving into some potentially market-shaking news that could affect every single investor watching this video. Before we jump in, make sure to hit that subscribe button and ring the notification bell because the information I'm sharing today could literally save your portfolio. So let's get straight to it. According to the Times of India's latest economic report, the Warren Buffett Indicator has reached an unprecedented 220.1%. Now, if you don't know what the Warren Buffett Indicator is, don't worry. I'm going to break it all down for you in simple terms that anyone can understand. The Warren Buffett Indicator, also known as the market cap to GDP ratio, compares the total value of all publicly traded companies in a country to that country's gross domestic product. Warren Buffett himself called this indicator probably the best single measure of where valuations stand at any given moment. When this ratio gets too high, it suggests that stocks are overvalued compared to the actual economic output of the country. To put this 220.1% figure into perspective, let me give you some historical context. During the dot-com bubble peak in 2000, this indicator reached around 140%. During the 2008 financial crisis lead-up, it was sitting at approximately 110%. So at 220.1%, we're in completely uncharted territory. This means that the total market value of US companies is more than twice the size of the entire US economy. That's honestly pretty wild when you think about it. But here's where it gets even more interesting. As reported by the Times of India, it's not just the Warren Buffett Indicator that's flashing warning signs. Two major financial powerhouses, Capital Economics and Goldman Sachs, are both warning of a potential S&P 500 decline. These aren't random YouTubers or Twitter analysts making wild predictions. These are institutions that manage trillions of dollars and have access to the most sophisticated economic modeling systems in the world. Capital Economics, according to the report, has been particularly vocal about their concerns regarding current market valuations. They're pointing to several factors beyond just the Warren Buffett Indicator that suggest the market might be due for a significant correction. Goldman Sachs, meanwhile, has been adjusting their outlook and warning clients about potential volatility ahead. Now, I want to pause here for a second because I know some of you might be thinking, great, another market crash prediction. And you're right to be skeptical. We've heard crash predictions for years, and the market has continued to climb. But here's what makes this situation different. It's not just one indicator or one institution raising red flags. We're seeing multiple warning signs converging at the same time. Let's talk about what investors should actually be watching for, because according to the economic analysis, there are several key indicators beyond just the Warren Buffett metric that we need to keep our eyes on. First up, valuations. As the Times of India report explains, current stock valuations are at historic highs across multiple measures, not just the market cap to GDP ratio, price to earnings ratios, price to sales ratios, and other fundamental valuation metrics are all suggesting that stocks are expensive by historical standards. When you combine this with slowing economic growth in certain sectors, you get a recipe for potential trouble. Second, earnings growth. The sustainability of current stock prices largely depends on whether companies can continue to grow their earnings at the pace that current valuations suggest. If earnings growth starts to slow, or worse, if we see earnings contractions, those high valuations become much harder to justify. Third, and this is particularly interesting, we're seeing specific examples of high-flying stocks starting to crack. The report mentions Trek stock specifically as an example of how even well-regarded companies are seeing significant declines. Trex, for those who don't know, is a decking and outdoor living products company that was considered a solid growth play for years. But even solid companies aren't immune when the overall market sentiment shifts. Now let's talk about what Daily Reckoning is saying, because they're taking this analysis one step further. According to their recent analysis, it's time to start hedging. This is significant because Daily Reckoning isn't known for being overly alarmist. They tend to take a measured approach to market analysis. Their February 20th report, as referenced in our sources, suggests that smart money is already starting to position defensively. When institutional investors start hedging their positions, it often signals that they're seeing risks that haven't fully materialized in market prices yet. So, what does hedging actually mean for regular investors like you and me? Hedging is essentially insurance for your portfolio. It's taking positions that will perform well if your main investments perform poorly. This could mean buying put options, investing in inverse ETFs, increasing cash positions, or moving into traditionally defensive assets like gold or treasury bonds. But here's the tricky part about hedging. It costs money, and if the market continues to go up, your hedging positions will likely lose value. It's like buying car insurance. You hope you never need it, but you're glad you have it if something bad happens. Now, I want to address something really important here. According to the blogger.com analysis on dividends and buybacks, there might be some bright spots even in a potential downturn scenario. The report titled Data Update 8 for 2026, Time for Harvesting, Dividends and Buybacks suggests that companies with strong dividend policies and active share buyback programs might be better positioned to weather market volatility. This makes sense when you think about it. Companies that are consistently paying dividends and buying back their own shares are typically generating substantial cash flow and have confidence in their business models. During market downturns, these cash returns to shareholders become even more valuable as growth becomes harder to come by. Dividend paying stocks historically have provided some downside protection during market crashes. While they're not immune to declines, they tend to fall less than growth stocks and recover more quickly. The income component of dividends also provides a cushion for total returns even when stock prices are declining. Share buybacks, meanwhile, can be a double edged sword. On one hand, companies buying back their shares at high prices might be destroying shareholder value. On the other hand, if a company continues buying back shares as prices decline, they can actually accelerate the recovery in per share metrics once the market turns around. So, what should you actually do with this information? Let me give you some practical steps, but remember, I'm not a financial advisor, and you should always consult with professionals before making major investment decisions. First, take a hard look at your current portfolio allocation. If you're heavily weighted toward high growth, high valuation stocks, you might want to consider rebalancing toward more defensive positions. This doesn't mean panic selling everything, but it might mean taking some profits off the table and diversifying into different asset classes. Second, consider building up your cash position. I know, I know, cash doesn't earn much return right now, but cash gives you options. If the market does correct significantly, having cash on hand allows you to buy quality assets at discounted prices. Think of cash as opportunity ammunition. Third, look at your dividend paying investments. As the blogger analysis suggests, companies with strong dividend histories might be worth overweighting in your portfolio right now. Focus on companies with sustainable payout ratios and growing dividend streams rather than just chasing the highest yields. Fourth, consider some basic hedging strategies if you have a large portfolio. This might mean buying some put options on major indices, investing a small portion in inverse ETFs, or increasing your allocation to traditionally defensive assets like utilities or consumer staples. Fifth, don't try to time the market perfectly. Even if the Warren Buffett indicator is flashing red at 220.1%, that doesn't mean the market will crash next week or next month. Markets can stay irrational longer than you can stay solvent, as the famous saying goes. The key is positioning yourself so that you can benefit from opportunities when they arise while protecting against significant downside risk. Now, let's talk about some potential scenarios for how this might play out. According to the analysis from Capital Economics and Goldman Sachs, there are several ways this high valuation situation could resolve itself. Scenario one, the soft landing. In this case, economic growth accelerates enough to justify current valuations, and corporate earnings grow into the high stock prices. The Warren Buffett indicator gradually declines as GDP growth outpaces market cap growth. This is obviously the best case scenario for current investors. Scenario two, the slow bleed. Markets decline gradually over an extended period, maybe 12, 24 months, as valuations slowly normalize. This wouldn't be a dramatic crash, but rather a prolonged bear market that grinds lower over time. Scenario three, the sharp correction. This is what most people think of when they hear market crash, a rapid 20, 40% decline in major indices over a relatively short period. similar to what we saw in early 2020 or during the 2008 financial crisis. Scenario 4, the Japan scenario. This is probably the scariest long-term possibility, a prolonged period of stagnant returns where the market trades sideways for years while economic fundamentals slowly catch up to market valuations. Which scenario is most likely? Honestly, nobody knows for sure, and anyone who tells you they know exactly what's going to happen is probably selling you something. What we can do is look at the data, understand the risks, and position ourselves accordingly. One thing that's particularly interesting about the current situation is the role of technology stocks in driving these elevated valuations. Many of the mega cap tech companies that dominate market indices are trading at valuations that assume continued rapid growth for years to come. If that growth materializes, current prices might be justified. If it doesn't, these stocks could face significant corrections. Another factor to consider is the global economic environment. The US doesn't exist in a vacuum, and global economic trends can significantly impact domestic markets. Slowing growth in China, ongoing geopolitical tensions, and varying monetary policies around the world all contribute to market uncertainty. Speaking of monetary policy, the Federal Reserve's actions will likely play a crucial role in how this situation unfolds. Interest rate policies, quantitative easing or tightening, and overall monetary stance can significantly impact how attractive stocks are relative to other investments. Let me share some historical perspective that I think is really important here. Every major market crash in history was preceded by periods of extreme valuations and widespread belief that this time is different. The 1929 crash, the dot-com bubble, the 2008 financial crisis, they all had similar warning signs to what we're seeing today. But here's the thing about market crashes. While they're painful in the short term, they also create incredible opportunities for long-term investors. Some of the best investment returns in history have come from buying quality assets during market panics when everyone else is selling. Warren Buffett himself has a famous quote, "Be fearful when others are greedy and greedy when others are fearful." Right now, with the indicator bearing his name at 220.1%, it might be time to shift toward the fearful side of that equation. As we wrap up today's analysis, I want to emphasize that while these warning signs are serious and worth paying attention to, they shouldn't cause you to panic or make drastic decisions without careful consideration. Market timing is incredibly difficult, and even the best indicators can stay elevated longer than expected. The key takeaway from today's discussion is that we're in an environment where caution and defensive positioning make sense. Whether that means taking some profits, building cash reserves, increasing dividend allocations, or implementing basic hedging strategies, the important thing is having a plan that you can stick with regardless of what happens. Remember, successful investing is not about avoiding all losses. It's about managing risk while positioning yourself to benefit from long-term wealth creation opportunities. The current high valuations indicated by the Warren Buffett metric don't necessarily mean you should sell everything, but they do suggest being more selective and defensive in your investment approach. What do you think about these warning signs? Are you making any changes to your investment strategy based on the Warren Buffett indicator reaching 220.1%? Let me know in the comments below. I love hearing from you and learning about different perspectives on market conditions. If you found today's analysis helpful, please give this video a thumbs up and subscribe to the channel. We're constantly monitoring market conditions and bringing you the latest analysis on what's happening in the financial world. And don't forget to ring that notification bell so you don't miss any of our upcoming videos. Thanks for watching, and I'll see you in the next one. Stay informed, stay prepared, and as always, invest wisely.